This week we continue with part 2 of our East Coast market update with our guest, Cate Bakos.
We're going to cover the key differences between the property markets in Sydney, Melbourne and Brisbane, and you're going to find out what your money will buy you in each city. Welcome to Your First Home Buyer Guide, the podcast for first home buyers who want to move it along and become homeowners. But most importantly, it is for you to become an educated home buyer.
I'm Megan and that was Veronica. We're both buyer's agents and probably old enough to be your mum. But it's a good thing because between us we've got over 45 years experience to share with you and bucket loads of stories about avoidable mistakes. Together we're going to make sure you get unbiased and real information you can rely on. Allow us to guide you on your home buying journey. We want you to become an educated home buyer so that you can stop looking for your first home and actually become a proud homeowner.
We've got loads of great tips for you in this episode, and if you'd like more useful tools, head over to the website homebuyeracademy.com.au, and there you'll get access to our free mini course, How to Price a Property Like a Professional. You will also find the holy grail of home buying education, Your First Home Buyer Guide, the online course for people who want to become educated home buyers. We created this for you to help you get on the right path to home ownership for your first home and beyond.
But before we get into the interesting stuff in this week's episode, we've got the boring bit, the disclaimer. You of course know that nothing in this podcast is to be taken as personal advice. We always recommend getting the advice of an expert in their field who takes the time to understand your personal situation. We've done our very best to ensure that the content is correct at the time of recording. Things change rapidly, so always check with the relevant government authority and your trusted advisors to get the most up-to-date information. Now, I know this is probably where a lot of people have stayed with us to find out what you can buy for different amounts of money in our 3 capital city locations.
Yep.
Cate, kick us off.
All right, let's talk about $600,000 to $700,000. This is either first home buyer territory because our concession for stamp duty finishes at $750, but below $600, it's free. So we've got a sliding scale between $600 and $750. So we do have a few first home buyers here, but we've got, if anyone is going to invest in Melbourne, and that sounds awful because I see the opportunity, but if we've got interstate investors, you know, a lot of Sydney and Brisbane people look at Melbourne now and they do think we're Mexico, particularly with the median house price data out. You know, we've lost our place on the league ladder there. And they're looking for something, and they almost always want a house. They don't want to buy an apartment or a townhouse. And so I start talking about Geelong, Ballarat. They say, no, we want Melbourne. So between 600 and 700, you do have to make some concessions because you're dealing with lower socioeconomic areas. And I can select some that I feel very confident will deliver growth over the long term because of a variety of things, whether it be, you know, some great projects and it might be the train connection to our airport. It could be other infrastructure projects. It could be the really big hospitals where a lot of investment's going in and a lot of professionals are working in those areas. We do have a few to choose from, but they're not in the inner ring and they're not blue chip. So 600 to 700, you can buy a house in Melbourne, and in the west, it would be probably around that 17 to 25 kilometre out. Interestingly, in the north, if you can get to 750, you can buy something in that 16 to 17 kilometre distance. And I've talked and blogged about some of the suburbs around the Northern Hospital, so the likes of Thomastown and Laylaw, which are just above the Ring Road. We've seen an enormous amount of popular housing activity stretching up from Northcote, Thornbury, Preston, Reservoir. Anyone who's Melbourne-based will know what I'm talking about. They're all on the one train line. Once you get to the top of Reservoir, you've got to kind of cross that difficult barrier, which is the Ring Road, and that takes you into Thomastown and then Laylaw. So those are old areas that similar to the areas that I'm talking about in the western suburbs as well. You've got brick and tile, you know, triple-fronted homes on anything from 500 to 800 square metres of land. So for a lot of people who are looking at long-term investment, capital growth potential, they're eyeing up all of those things. Could they subdivide? I get all of these questions all the time. I personally think going for something that's not necessarily subdividable in an area that's not subdividable will give you peace of mind that your streetscape will stay nice and family friendly and pretty. But yeah, that's my little list for the 600 to 700 price point. And I'll throw that over to you, Megan. What can you get for 600 to 700 in Brisbane?
A lot less than 12 months ago. And that's the interestingly, first time buyer stamp duty concessions changed on the 9th of June in Queensland, and first time buyers now are fully concessional, so zero stamp duty up to $709,999, which is quite an increase on what it was, which has opened up a little bit more for first home buyers. And as we all have said, first home buyers often compete with investors with a similar sort of budget. So fully concessional up to $710,000, and then a sliding scale of concessions to $800,000, which is much more in line with first home buyer style properties. Now, we're not just focused on first home buyers here, although Veronica and I can sometimes slip into that space when we're talking to each other in this. But in that 600,000 to 700,000, you're really looking at a 2-bedroom unit, 2-bed, 2-bath, 1-car unit, or a house that is out. There are select locations in the Western Corridor that will buy in just specific property types in specific locations. There's a lot of risk in that Western Corridor because there's old mine shafts in certain suburbs. There's black soil that's really reactive that makes slabs actually really unstable. So there's structural issues in some locations. There's a lot of land still to be released in some locations of that Western Corridor. I'm talking out to Ipswich. So it's an area that you have to be extraordinarily well across and have great local knowledge. I personally don't have that local knowledge, but I have a valuer on staff who has been in that area for 20 years and he knows it like the back of his hand. So that's really where you're going to find a house with some infrastructure projects and some gentrification that are happening that would be positive for those locations, or a unit, probably not a house. Now, interesting, we're going to talk about the next price range shortly, but that changed really, really rapidly. You used to be able to buy a house at around the 12 to 15 kilometre radius from the CBD up until about 12 to 15 months ago. So it changed very rapidly.
It's actually interesting, before I hit you with what you get in Sydney for that money, which you can probably all guess what the answer is, but when we have investors come and talk to us and say, oh, what can I get in Sydney? And usually I say, don't invest in Sydney at that budget. In fact, that cab, that ship has sailed, that horse has bolted. $600,000 to $700,000 in Sydney is not going to buy you an A-grade property. It's just not. And so I've always directed people to go, and until recently we would have said, oh, look, perhaps you should definitely talk to Megan in Brisbane, her team in Brisbane, maybe talk in Adelaide for argument's sake, right? But since Melbourne has been in the doldrums, it's like all of a sudden Melbourne, Adelaide and Brisbane are all in the same, they're in cohorts. So you guys are in the same cohort. And I will just knock Adelaide out, and I know that people will argue with me that Adelaide's a great place to invest, and I'm not saying it isn't. But I think that when you got to look at the Eastern Seaboard and the population that we have on the Eastern Seaboard and the drivers that go into an investment market, if you've got the opportunity to talk and look and compare Melbourne and Brisbane, I would. I wouldn't be looking further away into our smaller cities. So 600 to 700,000, pretty much, I would say, look elsewhere. And I'm going to just take over 700 to 800,000. That's our next bracket, and say the same thing for Sydney. So over to you, Kate.
Okay, so the next bracket, if I'm dealing with a first-time buyer or an upgrader, and then they're wanting something closer into town, you can get a particularly nice villa unit or a smaller townhouse or a really great apartment if you're in the east for this kind of budget, and you just see a bit of that. To be looking at houses, though, for upgraders, for families, it's not really a commonplace budget. It's a difficult one, unless you're going into those areas that I was speaking about before, but they've tended to attract more investor interest because of, the potential longer term for growth through infrastructure projects. And let's talk about upgraders. They really want good schools and community around them, and often they want to be close to parents. So this isn't really the price point where I'm looking at family homes. I'm either working with first home buyers or someone wanting to be close into the city. And you can get quite close into the city. In fact, with this budget, you could get a good quality city apartment if there is such a thing. I'm being a little bit facetious because if you've already geared yourself up for high rise and you know what you're looking for, you're aware of cladding issues, you're aware of special levies, you've got a willingness to deal with high outgoings because your OC fees, they'll always be higher because there's lifts at a bare minimum. But when you've got gyms and pools and concierge, that's when your OC fees go through the roof. But if you've got a preparedness to deal with $5,000 a year in OC fees and you're very selective, you can get a great 2-bedroom apartment for $700 to $800, very close to the city or in it. So, that's certainly where we've been a little bit active with the inner city buyers as well.
Right. So a house in Brisbane, and again, I don't want to keep saying this to make people feel, oh, I missed the boat, but just to give an indication of the rapid changes. And if anyone is thinking about doing something, not to delay the actual action if they're in a position to do something. But one of my staff bought his first home in, I think it was late last year. He paid $690,000 for it in Capera, which is in that kind of middle ring on the train line. Just a good solid post-war house on about 700 square metres. So about $690 was what he paid for it. You can't buy that house now for less than $900,000. In fact, it's now into the mid-nines for the same house. And I say the same house because they are the same house. They're all in that area is the same house, 3-bed, 1-bath on a similar size block of land, made of the same materials with the same sort of layout, which is practical, good bones. And that's how much things have changed. In the $700,000 to $800,000 range, we're now looking at largely townhouses. What I like about townhouses in Brisbane is that they're not really making any more of them. So if you can get your hands, as an investor or a first-time buyer, if you can get your hands on a 3-bed, 2-bath, 1-car townhouse in a low-density, family-oriented suburb, they're not going to make them anymore. So there's a scarcity factor to them. They used to be a main sort of construction staple of developers, but a number of years ago with some rezoning, the same block of land can be either developed into townhouses or a 3-level block of units in Brisbane. So a developer will actually get more yield out of doing a block of units than they will out of a set of townhouses. So they don't do the townhouses anymore because they don't get the same sort of profit return. So that's where we are absolutely putting people with that $800,000 price range into townhouses, and they have been performing quite well, and the yield sits at about 5.1%. Body corporates, so you say OC, Veronica, your strata levies, body corporate levies are usually somewhere around the sort of $3,500, $4,000 because there's not many facilities there. Yeah, don't have pools, don't have lifts, just your average upkeep. Driveways.
This kind.
Garage doors.
Yeah.
Gardening.
Great investments.
Yeah. And they look, well,
highly sought after.
Yeah. And you get, in townhouses in Sydney, for example, a great stopgap between a house and an apartment. So if you can't actually afford a house in a good suburb and there's townhouses there, you get a bit of grass, you get a bit, it's a great middle of the road, I guess, property. Okay, well, I'll kick into 800 to 1.1 million. That's our next price bracket. And in Sydney, I can actually say something now. But it is slim pickings, right? So if we're talking about the inner rings, we're talking older style apartments in places like Ashfield, which is sort of, in the inner west on the edge of it, if you like. I mean, in the sort of northwest, we go into Gladesville, somewhere like that. The eastern suburbs, you can pretty much forget about it if you're looking at A-grade property. Not impossible, but it's extremely difficult, and I wouldn't be loving the apartments in this price bracket in the east. And the north, as I said, we're talking Gladesville, which is sort of northwest, really. There is the Sydney Metro new rail line is going in and is about to be open literally days after we're filming this. And that actually will extend and make access to the city for people in the northwest a lot better than it has been. They've been relying on this thing called, I think it's called the busway. Not that I go out there very often and we don't buy out there, let me tell you, but there's a busway that's been running along a motorway for, I don't know, decades now. And this new train line, or this new metro line, is going to connect those people that previously would have been in bumper-to-bumper traffic for a long time or dealing with bus-only access to the city, via a train line, they can probably get to the city in, say, 40 minutes from places like Kellyville, Castle Hill. So that is going to change and give some opportunities for investors who want to buy out that way. It's massive family home territory. So you're sort of buying big family homes or family homes. There's older parts of these suburbs and the newer parts. But there's also, a fair amount of apartments that have been built along that rail corridor in previous years, shall we say. So out there, you're going to see opportunities. I can't talk to them because we don't buy out there for our clients, but that's certainly an area that has had probably going to potentially the price increases that come from that new infrastructure probably already baked into the prices. So be very careful about that. But that's certainly a change in terms of accessibility to the city. And then what we do see in those older style units, though, is, they tend to be those 3-story red brick walk-ups. And they can be in, say, a suburb like Ashfield, for example, where there's a lot of them. You do have to be careful that you pick the right pocket of the suburb and the right buildings, again, within that suburb. So there's a lot of overinvestment in years gone by. As I mentioned earlier, a lot of buildings that have been heavily owned by retirees and investors who typically have wanted to keep their strata levies really low and not invest a lot in the overall upkeep of these buildings. So you do have to be quite careful. But, well-located apartments in well-maintained blocks can be really good. Over the UK, 800 to 1.1 million.
I'm still rocking in the corner about your comment about apartments in this price point. I like this price point, especially when I get the challenge of finding a house in the inner 10K radius, because it can be done. Wow. It will be little. If it's not little, that's not A grade. I know that's a snobby thing to say, but up to 1-1, I can get a great street and a great location and a really pretty facade, but it's going to be very little. It will be a 2-bedroom, single-fronted, period Victorian, and it won't have a lot of outdoor space, but it'll be great. And if you can find the tenant that's happy there, it's a single or a couple that get along, that's your market. And right now, every tenant is out. Melbourne's rental market is, it's not healthy, especially if you're a renter. But if you're a landlord, you've got really strong demand and you won't be vacant, even if it's a really tight little place. So I do love that challenge when someone says, I really want to be in the inner 10K radius and this is my budget. But otherwise, it gets you a good inner ring, a townhouse. And, there are plenty in this. You could obviously go to 1.5 for a townhouse if you wanted to. But between 800 and 1.1, particularly the inner north, inner west, and a little bit in the middle ring east, you'll get townhouses in this price point. And I do get a lot of investors that are wanting to get a house coming to me with this kind of budget. So it's often the investors that I'm getting the single front Victorians for. But you will really struggle to get a family home for this kind of budget. I've occasionally got lucky with a very small home, but I wouldn't call it a family home. It might be a 3-bedder, but you'd be looking at someone inhabiting it with 1 child, not with 2 or 3. And in the inner west, so I'll name some places, Kingsville, Newport, they sometimes have these little gems that are well located and period house, 3-bedder, double fronted for that kind of price point.
Pretty.
Brisbane is probably, I'm going to extend the range slightly, even though they were ranges that I suggested, probably up to about 1.2 is where I would say 800 to 1.2 here is where you're starting to get into a small house on a reasonable block in about that 12-kilometre radius from the CBD. So generally with a good set of bones, practical layout, not flood affected, not on a main road, not adjoining the railway line, but within walking distance. This is where you're starting to get, and it's very close to our investor sweet spot, which is about 1.2, is really where we're buying really quality investment properties at the moment. Generally, anything in this price range is going to need work. So it's going to be your fixer-upper, your renovator's delight, you bring your toolkit kind of property, if it's within that 12 to 15K radius of the CBD. A little bit further out, so around that sort of 20K radius from the CBD, there are some opportunities. But one of the things that's really driving prices that aren't connected to their vicinity or their proximity to the CBD is school catchment zones. So we're seeing in this over 1 million price range a lot of areas that would not have any other reasons to be high in price other than people wanting to get their children into public schools that are performing exceptionally well in the schooling system. So people who are wanting to get into those school catchments to avoid the private school fees, but to get the education they want. And there's particular areas around McGregor State School, which is highly sought after, where prices have gone beyond what would be even astronomical price growth for any area. And they're not fundamentally the types of prices that properties that people usually buy in Brisbane. You know, they're not the timber tin Queenslander houses. They're generally brick and tile, more Sydney, Melbourne type properties that people are going for. So proximity to CBD isn't really the only driver for those types of things. What I think is really interesting is if the principle of that school changes, and it will at some point in time, and the popularity or the attractiveness of that school changes, will that have an effect on housing prices? I think possibly yes. So there's an X factor there in this price range and even a little bit above this price range, which is, I think, a little bit risky because it's not based on the fundamentals of properties.
It is interesting, isn't it? There's the upper North Shore of Sydney is very much driven by schools. And there's a lot of private schools up there, but there's also selective public schools, et cetera, and yeah, there's very much this idea that people will sacrifice. You know, if they've only got one child, they're sacrificing 6 years of their life for the kid's high school career. But of course, if you've got more than one kid, you know, how long are you going to basically unplug your life so you can live in a place purely because of schools? And it's quite a common thing, though. I don't get it, but it does drive certain markets and absolutely does drive the upper North Shore of Sydney. Okay, so the next price bracket is 1.1 to 1.5. Certainly that does open up things in Sydney. We struggle when investors come to us and say, yes, we definitely want to buy in Sydney, but no, we don't have over $1 million. All right, so when we get over $1 million in Sydney, so say we're looking at $1 to $2 million, well, that really does open up opportunities for investors. You know, at the lower end of that, we are looking at apartments, and depending on, you know, typically for investors, we do favour south of the bridge, the bridge, capital B. And in fact, in Sydney is definitely a city governed by bridges, right? So people don't like to go over bridges. So the Harbour Bridge is what I'm talking about there. And the eastern suburbs and the inner west, they do offer great opportunities in terms of well-positioned and well-selected, shall we say, apartments in the lower ones, right? So that 1.1 to 1.5. And when you go over that, you know, more options will open up in the eastern suburbs. And we like the inner suburbs such as, you know, Surrey Hills and Potts Point and places like that, because it's really driven by lifestyle and people with high incomes want to live there and they will pay good rents. So, you know, they are areas that do very well for our investor clients. Also driven by owner-occupiers. You've got people that are very happy to buy there to live there as well. So it's not pure investor-driven markets. These are just highly desirable aspirational markets. Yeah. And so we do love that. There's parts of the inner west that do equally well, but they are more affordable. They're just less expensive than the eastern suburbs. The lower North Shore, it just has, depending on which suburb, I mean, closer to the harbour, we favour those areas as well. So, and obviously, if you can buy a 3-bedroom apartment, they are really scarce. So we do like to look for those as well, as opposed to just your 2-bedders. You're also, when you get close to $2 million, you're actually starting to think maybe we could get a little house. A little bit like Kate's talking about the inner suburbs, the little cottages, the single-fronted cottages. They might be brick, they might be weatherboard. They will be on small blocks of land. They often can be renovated. So if they've been, you know, 2 bedrooms at the front, a bathroom in the middle, opened up at the back, not always with parking, sometimes with parking. It doesn't have to have parking depending on where it's located. So well located, you know, period cottages, they are always in demand. There's always somebody wanting to rent one, always somebody wanting to buy one to live in it. So for us, we love to look at that type of property as somebody does have the budget to be able to push up closer to 2. Although, to be quite frank, that is now for good properties that have been renovated, that are well located. You're now starting to see them in some suburbs definitely pushing over the 2 mark. So it's quite bizarre. You think it's basically double the price that it is for the equivalent property in Melbourne. It didn't used to be, the gap didn't used to be that big, which lends me to think maybe that opportunity in Melbourne is really that type of property, perhaps.
Well, you said it. I cannot believe it. I can't fathom that. To spend $2 million on a single-fronted Victorian terrace or freestanding down here, it'd have 4 bedrooms and an upstairs retreat. It would be that amazing renovation I was talking about.
But what we have to be careful here is what we like to talk about is what does your money buy you? But what we are talking about is focusing on always A-grade investments. You don't turn around and go, oh, that means that I should be buying two in Melbourne where I could just buy one in Sydney. For some people, the right decision is to put more into one property in Sydney. For others, they don't have that budget, so they should be looking at buying, in either Brisbane or Melbourne and spending less money and buying a really cracker asset. It's really about the best possible asset you can buy regardless of where it is. And I will always encourage people to look in other states rather than try to buy in Sydney, because conversely, a lot of people look at Sydney and say, oh, it's the most expensive, it's had its day. That's it. All the growth is gone. And there'll be other people look at Sydney and say, well, look at Sydney, it's so strong, it's never going to go backwards. There's been times when it has. So it's always about choosing with that long-term view, but also understanding that things can go wrong. And really the best...
It can be a rocky ride.
Yeah, the best defense is a good asset though, right?
Yeah, it's okay. You were just going down the path of saying what in that $1 to $2 million range, what are you seeing?
My sweet spot. There are some buyers agents down here in Melbourne whose sweet spot would be above 3. They might be, Brighton-based or South Yarra-based or something, dealing with the premium end of the market. But when you're dealing with mum and dad investors, upgraders, family home buyers, this is definitely a sweet spot for me. I'd say 1.2 to 2.5 is actually that home sweet spot, but a lot happens in the sub $2 million range here and all sides of the city as well. I've had some fantastic acquisitions in the eastern suburbs in this price point too. Often in that 1 to 1.5, I'm dealing with maybe sophisticated first home buyers who have planned for their family home. They haven't done the apartment thing or the stepping stone. Mm-hmm. They've had an arrangement that's worked for them. They've probably been in professional roles. They've been able to afford the rent. They've got a great relationship together and they've decided, right, now's the time. So they've both got savings. They've pooled it and they're buying their future family home. And it might be a stepping stone family home, but at the time that they're spending 1.5 on it, they're pretty committed to getting quite a few years out of it. And I always say to people, if your tenure in mind is less than 5 years, I don't want to touch it. And if it's less than 5 years, I don't want to touch it. Less than 10 years, we need to talk about this, because I do like to future-proof. When you factor in stamp duty and selling fees and all of the other costs that go with selling and buying, and the risk that you take when you're dealing with either being homeless or having an Airbnb or getting bridging finance, get it right the first time. If you're buying a home for your family, I want to see you talking about 10 years plus. So this is the price point range where those conversations take place for me. And occasionally I'll have an investor that's happy to spend over 1.5 and get a cracker. As you said, Veronica, in this climate though, that's not happening. 2-3 years ago it was happening. I even had an investor that was happy to spend 3 on one property. And boy, oh boy, did I get him a great property. It was awesome. And he had the cash flows to sustain that. But in this environment with lending rates above 6%, I'm not seeing investors shelling out this kind of cash. They're really comfortable capping it about that 1.2 mark.
I will say that typically the type of investor we do get in Sydney is actually looking about 2.5 up to 3.5. It's
it's just different, isn't it?
It is.
It's different.
It's because they know that's if they decide to invest in Sydney, it's like for whatever reason the rest of their portfolio allows that is a sensible thing for them. But it's certainly, a lot of people wouldn't want to chuck all their eggs in that one basket. That's for sure.
Too true. So Brisbane, this is a really interesting one. It's almost a tale of two markets. In that mid-1 to mid-2 range, you can get a really good family home. So 4-bed, 2-bath, maybe a reproduction Queenslander, 2 living areas, double lock-up garage on a 405 square metre block. So Brisbane was largely subdivided in very similar sized blocks. 405 generally has a 10-metre frontage, 40-metre depth, and they're a very low maintenance. Still has a little yard, can put a pool in there. You can get a really nice quality property in the high $1 to $2 million that you can move in and just enjoy in a family-friendly suburb, A-grade location, north-facing rear, or you can go onto a bigger block of land and have less house. So this is where we talk about the 3 Ps, position, property, price. This is where people are really starting to make trade-off or discuss trade-offs between the house that is really livable and nice and well done on a smaller lot, or in the same location, a renovator on a slightly larger block of land, but it needs a lot of work. Livable, but probably only 3-bed, 1 bath in the same location. So this is where people have the opportunity to say, well, am I going to land bank and do something with this? And can I wait until trades are ready? And can I stomach the price of renovations now? Or do I really want that smaller block of land and I'm straight into it? So places like Cooperoo, which is only a few kilometres south of the CBD, you can pick up a 4-bed, 2-bath, 2-car on 405 square metres, move in ready, very nice, walk to the cafes and so forth for high ones. Similar on the north side in Ashgrove, which happens to be where I live, similar type property for the same kind of money, about 5 kilometres from the CBD. But you would pay 1.86 was a recent sale on just under 700 square metres. So bigger block of land, comparable location, but it was a 3-bed, 1-bath that hadn't been touched since the 1960s. But a character Queenslander would renovate up to a $3.5 million property if you put $1 million into it. So it has that potential, but not move-in ready. So it's a really interesting price range because you can either get done, but small block, or not done, needs a lot of work, but you can turn it into something that is, takes you to the next level in terms of the house and the value of the house.
Amazing.
All right, so we're just going to quickly run through rental market, a bit of legislative reform, because, if you're looking to invest in any of these cities, you need to be aware of what's on the horizon, and land tax. Very quickly, rental market in Sydney. Now, we are in the middle of winter recording this, so this is a 2024 report, if you want to call it that. Mm-hmm. And what we're seeing, though, the frenzy has definitely slowed over winter, and that's not unusual. There is a seasonality to the rental market. And certainly as you get, you don't want your lease expiring over Christmas, definitely not. And typically winter months in Sydney have been a bit slower in terms of people wanting to get out there and move house. But that said, there's still, so there's a lot more available for rent, but there's still a lot more people for each property than is a balanced market in the rental market. So the rental growth has slowed. It's a little bit less frenzied. Sometimes an overpriced property will not rent straight away. It will still needs to have the right rental, what's being advertised. And so that's what we're finding at the moment. Over you, Kate?
Our rental market has rebounded like nobody could have imagined, but we came off the lowest base. During COVID, you couldn't give them away, and the city was a ghost town, and we had a huge drop in rental values for quite a while. And then when we bounced back, we really bounced back. And units initially were the ones that bounced back big time because people did return to the city. And we've always had a vibrant city. We had an oversupply issue, which was, putting a ceiling on what investors could expect. And then all of a sudden our construction woes kicked into gear and we didn't have new construction. And we saw, if you looked at the data, days on market for sales were quite extensive. They really stretched out. And then when you looked at old listings, which is defined as 180 days old plus, that quickly got eroded. And what that said was people were just coming in and buying up all of these things that had been floating around for a long time. Some of them might have been undesirable. All of a sudden they were desirable. And that was when people were returning to the city and getting their city pad. And first home buyers were getting back into buying as well. And of course that pulled it out of the rental pool because they're selling to second home people and to first home buyers. And so all of a sudden our rental pressure on the apartment market went through the roof and they soared. And at one stage, I think Melbourne peaked at 18% year-on-year growth, which is pretty harsh. And then houses mirrored that about 6 to 6 to 12 months later, the housing values for rents climbed and peaked as well. And people are saying low rents have come off. They haven't come off at all. The rate of growth has slowed down. We're still not far off 10% year on year for houses and units, which is pretty nasty. And you can pick and open for inspection whether it's a rental or a sales, because the rental line is much longer and it sometimes stretches around the corner, especially in the trendy inner areas. It is brutal. And we've been getting phone calls and emails from people just reaching out for a little bit of a helping hand, saying, can you put in a good word, or do you have a rent roll? Can you help me out? And that's real desperation. It's pretty awful. So while we've got this, really aggressive demand, we've had a lot of investors opting out of our market because of legislation, which is the next point, and I won't touch too much on that. And it's all been amplified. The stress has been amplified by interest rates where they're at. So if investors were thinking they were getting annoyed with legislative changes and the land tax, the hardest part is actually the cash flow.
Yeah, so true. And that that's certainly across the board. And in Brisbane, look, I can say from our rent roll, so the properties that we manage as a company have gone down by 30% since COVID. So the amount of investors who have sold their properties, 30% of the properties. Now, that's not unusual. Talking to other principals of property management companies, they have seen similar numbers, and almost all of those properties have been sold to owner-occupiers. So that's a big part of where this pressure is coming from, is when an investor chooses to sell, and that's not bought by another investor, that's not even increasing the stock of properties available to rent, that's decreasing it. So we're not seeing a huge amount of investor activity adding to the investor pool. We're seeing it come out of the investor pool.
There are some arguments, and I think we should acknowledge this, even though we may not necessarily agree with it. There's some arguments that say, oh, well, if an investor sells to an owner-occupier, that's okay because that owner-occupier was renting, and so that's one less tenant. But I think we just need to flag that that's not necessarily always the case, is it?
No, it's not. That's why. And also, if we think about what's happened since COVID, we've seen household formation rates dropped. We saw a lot of divorces, especially down here. And so all of a sudden you need more houses organically because you've got separations. And if we think about first home buyers purchasing property, that could have been house sharing, and they're driven out of those arrangements now because of our rental reforms. These old affordable rentals don't really exist. Student housing, it's not what it used to be. We used to just wear a blanket because the heater didn't work. Well, landlords don't get away with that now. And of course, that cost is rolled out because it's a better quality property because everything works and it's compliant. Well, you're not going to get it for $50 a week.
And that's the thing. And then this is something that, we can, it's a bit of a segue here, but when you increase the costs to landlords, there is a knock-on effect to tenants, and this is something that often the do-gooders forget. And rightly so. Everyone has a right to a secure and, I think, warm roof over their head. But there is a knock-on effect, particularly when in this country the burden has been placed on individuals to provide this rental stock. But, we've got no grounds evictions about to end. That's just been announced in New South Wales. And, to be honest, I'm not necessarily in disagreement with what they're proposing as a legislation, because there are ways in which, owners do retain a certain level of control over their property, right? So there still are reasonable grounds upon which you can terminate a tenancy. And so, for the sale of property, for argument's sake, there is one. And or if the tenant themselves are misbehaving and breaking all the rules, then obviously that you need to be able to terminate. So I think, to be honest, we do have an issue here. But the problem is, of course, when you do restrict an owner's flexibility with what they can do with their property, there is a knock-on effect, and it does usually translate to either being some tenants, possibly the most needy ones, can no longer afford any accommodation. So it is a risk and it is a challenge, isn't it? But that's probably a bit of a side issue.
It is, and it is a greater discussion because there's so many points in there that really need to be investigated, and that's not what we're here to do tonight. But you raised so many good points.
But I think everyone who's investing needs to be on notice that this is a changing landscape.
It is a changing landscape, yeah. So certainly in Brisbane, very tight, similar to you, Kate, lots of people around the corners lining up to go through. But what has stopped now and has been, and this is moving into the legislative sort of arena, but people used to be able to, you couldn't encourage rent bidding in Queensland. That was illegal. But if somebody chose to pay more than the advertised rent, if they chose to offer 4 months, 6 months up front, if they chose to do those things, then it was the owners, it was on the owner to accept that or not accept that. That's actually been legislated against now. So whatever the advertised price of the property is, everybody can only offer that. There's no differentiation. So I think that's a part of the landscape that property managers are really struggling with at the moment, because their job is to obviously get the maximum rent for the owner. That's part of their representation to the owner. But they also want to make sure they're attracting enough people to the property to rent it. So if you put that asking price too high and you don't attract any applicants, then you might actually completely miss the market. So it's a very tricky landscape for property managers to price that property within the legislation, but it's now not driven by the tenants as to how much they're prepared to pay for it. It's a really tricky sort of space for people to be navigating at the moment. We've also had minimum housing standards come in. I think that everything in that was pretty fair, to be honest. I think that any place should have everything that's in the Queensland minimum housing standards. It's locking windows, it's very basic things. We don't have heating as one of those requirements, Kate, but it's some very basic things and reasonable things. And end of lease, that's been in really since COVID, certain grounds upon which you can terminate a lease at the end of the lease, so at the expiry of a fixed term. And they're very similar. It's owner moving back in, family moving back in, sale of property or major renovation are the reasons that you can say to a tenant, look, we're not going to offer you another lease. But I think one of the difficult things is now rents can only be increased once every 12 months. Now, that doesn't relate to a tenancy. It actually relates to the property. So even if a tenant is in there for 3 months, breaks lease and moves out, that property, the rent can't be increased until the 12-month anniversary of the last rent increase.
Interesting.
Now, this is a vastly different landscape, and it is putting, it is meaning that when an owner puts a lease together, if that anniversary date comes during the lease, they have and they can put that rent increase during the lease, which is reasonable because the last time they were able to increase the rent was 12 months prior. But for the tenant who goes in, yes, they're signing up for that, but that can be a bit of a surprise if it's 3 months into the lease or 6 months into the lease and they were hoping to get 12 months out. So there's a little bit of a negative knock on to the tenants because of the legislation as well.
Oh, and it makes it really complicated too.
It's really complicated. Yeah.
Unintended consequences, whoever thought the government wouldn't consider that.
Yeah, and I think that's the thing, Kate, is it's the unintended consequences that have the negative knock-on effect to the party upon which they were hoping to protect or who they were hoping to protect. Yep. And that's what we're seeing play out at the moment. And that's not, I really get a bit frustrated when people say greedy landlords or whatever the case may be. There are some landlords whose rent went backwards for 5 or 6 years before COVID and then went backwards during COVID, that only actually got back up to where they were 10 years prior after COVID. So it's not that they had astronomical growth, it's just kind of caught up to where it was previously, and that was because there was an oversupply and a lack of demand.
We have to ride the wave, and this is my argument as well. It's like, landlords aren't putting up prices because like interest rates go up, for argument's sake. The rents go up because the market will pay it. And that's the only time we can put it up. And so legislation obviously is trying to control prices. And as I said, this is something to be, I guess, on notice. I mean, there are other things that are in the wings in New South Wales as well in terms of legislative change, and part of that's around the rental increases and restricting it to one increase every 12 months and et cetera, et cetera. So I think whilst the legislation is going to be different in every single state and territory, there are certainly some common threads running through them. The land tax is different though. Let's hit Victoria first, because you guys really
had the biggest impact.
Yeah, you're down to a $50,000, unimproved land value threshold now, isn't it? It's practically
like if you went out to a regional satellite village and bought a dog kennel, you'd still be paying land tax. Like it's a very low threshold. And let's talk about what this land tax increase is. They're calling it the temporary tax. It's an addition. And it will last for 10 years if it stays in place. And it's because of our cost blowout during COVID. And they've chosen to hit property investors. It's not hitting any other types of investors. So anyone who's a share investor and they're making profits, they're not being hit. So there's a degree of nasty bias to it, in my opinion, because there are more places to get land tax from than more to get cost blowout. Yeah, that's right. There are other ways to do it.
Yeah.
Will they?
It's also sort of, you're stuck with it because you already own the property. It's not a choice that you've entered into that property knowing what the cost was.
Yeah, and
like that's the thing that's unfair.
I do too, because a lot of people deliberately chose properties with a certain dutiable land value to be under that threshold. So that's probably bitten a few people that were purchasing cash flow properties and were sensitive to cash flow. That's a harder burden for them. But as much as I think it's a ridiculous tax, I don't think this alone should make or break an investor's commitment to buying and holding long term. However, if you're an absentee owner, if you live overseas and you're categorised absentee, it absolutely doesn't stack up. I ran the numbers for someone who reached out to me, not a past client, but someone who holds property and wanted to verify something. And I jumped onto the calculator, and his land tax bill is $110,000 per year.
Whoa. On an individual property, a single property?
Yeah.
Wow.
I mean, granted, it's a nice property, but that's not viable.
No. It's and this is a thing, isn't it? That it is an interesting. Everyone needs to work out what their obligation will be before you buy a property, but it can change. I mean, this has changed and caught some people out. In New South Wales, we just had a change here too. The threshold is now set in concrete. So what that means is effectively is an increase every year, because the threshold previously would go up over time. It was indexed, whereas now it's said, right, now it's going to be set at $1,075,000. So it's not bad threshold compared to $50,000. But, next year if prices rise, that threshold will not rise. It will stay the same. So over time, that means that New South Wales, people with investment properties in New South Wales that sit over that threshold, and it doesn't take a lot, depending on where your property is located, for it to exceed that threshold. Particularly if you're in the inner rings of Sydney, the land prices are very expensive. So that's something to be aware of in New South Wales as well. And typically people would diversify and buy in different states. One of the reasons the three of us are talking, because you might buy one in Queensland, one in Brisbane, one in Brisbane, one in Sydney, one in Melbourne, in order to defray those land tax obligations. And so you're not buying all in one jurisdiction. But Queensland failed in the government failed in their attempt.
We'll get to that in a minute.
Yeah. So what I mean is that like Kate said, you should not be making decisions based on land tax. You should be making decisions based on your long-term objectives and buying an asset that will grow in value in such a way that when you get that horrible land tax bill every year, as I've done many years, and looked and went, okay, what's my property worth now versus what it was, when I first
cost of owning the asset.
Yeah. And you can't even do it just for 1 year, although I have done that at times, because really you've got to be thinking long-term always when it comes to property. And if we are looking in short-term, in short periods of time and assessing the performance of our properties, we can knee-jerk, and it's not something to do, in my view.
Certainly. And you alluded to what was potentially a catastrophic legislative change that was potentially going to come in Queensland, didn't. But look, the fact in Queensland is that land tax is levied on the rateable value, or the value of the land, not the market value, but the rateable value of the land for properties that are not principal place of residence. So we're talking about properties that are investor only, not the home that you live in. That is exempt. For individuals, so if you buy an investment property in your own name, the concession is up to $600,000. So a lot of properties will fit into that category in Queensland. But if you buy in a trust or a company or some other entity other than individual name, then it's only $350,000. And many of the high quality properties are going to fit into that category. So the rateable value of the land is going to be more than the threshold. So land tax then will apply. Veronica, you talked about people often diversify and spread their risk by buying in different states. what the Queensland government proposed to do was to force the other states to reveal related entities that owned properties in different states and then tax the individual who was associated with that related entity on the entire value of their Australian portfolio in Queensland, so at Queensland rates.
Quick sale decision that we made.
The amount of people that rang me and said, Megan, I'm selling, I'm out, I'm done, I cannot, this is, it's just, so luckily the REIQ were instrumental in lobbying against that and sense prevailed, let's call it sense at the time, but it didn't come in. But what land tax does I think for people is it is cost of holding the property. There's no doubt about it. But when a tax changes after you've purchased a property, that I think, Kate, for Victoria, that's been such a difficult thing to watch from afar and say, well, these people didn't make these decisions, these big long-term decisions with that in play. It's sort of been forced upon them, and this tax is a very difficult thing to calculate and live with every year. And it's the value. So in Queensland, it's the value of the land on a date, 30th of June in the year. If you dispose of that property and the settlement is the 29th of June, you don't get a land tax bill for that year. If you dispose of it on the 1st of July, you pay the full land tax for that year. So it's something to be really, really aware of when you're thinking about disposal as well.
We're the same on the 31st of December, so it's not prorated. Exactly right.
No.
It's the same deal. That's our cutoff date.
When it is on, if you own it on that date, regardless of when your sale date is or disposal date. Yeah.
All right. So we've just covered off some differences, not a lot of similarities actually, but mostly differences across those three major cities. Do we want to have a super quick wrap up in terms of what do you think? Risks, key drivers, opportunities. 2 sentences. What do you reckon, Kate? Can you do it?
Yep, sure can. Risk, I don't think there's much more risk. Like, they've exposed all of the risk, really. They've gone pretty hard. And I'm not being smart. I think Melbourne's had a really tough run. Victoria's had a tough run. Key drivers, we've spent so much on infrastructure. I mean, that's partially why we're in a bit of a mess right now. We've got a bit of a deficit problem, but we've got some practical things happening around our city. We do remain a favoured port for new arrivals. And we've got some big employers down here. We've got healthcare employers. So there's a lot going on that will continue to attract a crowd. And I think when things settle down and people get their heads around everything, we'll see Victorians staying put a little more than they have been. Let's talk about the opportunity, though. The value proposition is enormous. And I've helped so many Sydney-siders who have moved down here to work or have decided to invest. And it's not just Sydney-siders, but it's mostly 90% of our activity with investors is Sydney-siders. And I think also the opportunities once our market picks up and people can, at the moment we've got investors saying, well, I'm dealing with this land tax bill and I haven't had any price growth on my asset. What's the point? When we see some price growth, that will be aided from a number of things, but it will most likely be an economic recovery for Victoria, but also inflation woes calming down and interest rates either reducing or settling and less panic around economic conditions. So in short, I think there's upside. The question is, when will we see those opportunities?
Yeah, which makes it, everyone says, I wish I'd bought at the bottom of the market. God, it's
come on, we're right, Melbourne, and we're staying put as well. It's not like it's bottomed and it's down.
It's like it's yelling, here I am at the bottom.
But they don't want to because they want to wait. They want to wait in case it drops further.
The green shoots of recovery. But I think you're right, Kate, and it's sort of been sitting in the back of my mind for some time. And I'll never, recommend anything outside my area of expertise, which is why we always say, talk to you about what's happening in Melbourne. But it just seems like it has been quite flattened at the bottom for a while. So, I'd second that for opportunity.
How about you? What do you reckon in Brisbane? What are your market risks, Megan?
I think the risk at the moment is we have been in FOMO. Buyers have been in FOMO for so long that they are prepared to compromise on the wrong things. And a poor asset is a poor asset regardless of what you pay for it and what the market is doing. So the risks are that people rush into a purchase without doing their due diligence thoroughly, that they don't understand the right due diligence that they need to do because there's so little seller disclosure in Queensland. It is really up to the buyer to know what to do, how to do it and how to interpret it. So I think the risk is that in the fear of missing out completely or being priced out completely, that people make poor decisions, and those poor decisions in the long run will have a bigger impact on them than if they'd been a little bit more careful and cautious and bought a good asset. I think the opportunities sit in those renovators, the properties that you really have to kind of live with for a while until you can pull together enough money to turn them into something grander, almost a stepping stone within the one property as opposed to stepping stone between properties. Because it's the same thing that I've done myself. I've done buy it, renovate it, use the equity or sell it and go to the next property. They're the properties that are being not largely avoided, but there are opportunities there, I think, if you're prepared to wait it out and do the renovation on them and put, a fair bit of money into a good property to do that in a good location. The rental market for investors, I think it is about being very discerning about what you buy and where you buy and not being too sensitive to price point. And what I mean by that is if you say, well, I'll spend $1.2 million on that property and you've set that limit yourself, but a better property in a better location is there for 1.3 and it adds up, then taking that self-imposed limit away might get you an even better property far in excess of what you would get if you sat on that, I want to stay under $1 million, particularly that price range, is a little bit more riskier. So I think good opportunities that we've still got the Olympics to come. So there's a great deal. I would probably say that's a bit of a risk too, is putting too much emphasis on where are the Olympics going to be, where are they going to be held, and where's the money going to get invested, because Brisbane's really not that big. You can get anywhere in about 20 or 30 minutes. So if you focus on quality asset, where the Olympic venues are, I don't think that's going to have as big an effect as it might have in the past.
Only 2 weeks of it, Anyway, I just remember back to 2000, the Sydney Olympics. So if we look at market risks in Sydney, Sydney obviously being the most expensive city, the market risk is cash flow, really, in many ways. It's like you've got to be able to fund it and sustain it. And what if interest rates go up, et cetera, et cetera. And also Sydney yields or rental yields have typically been the lowest in the country as well as a consequence, in a way. Rents are much more constrained, I guess, by incomes than price growth, because there's other aspects or elements that go into property prices. So I guess that is a risk in terms of anybody investing in Sydney has to be able to basically stump up some of the costs for, quite a few years. And it might be 10 years before you even get into neutral gearing territory. So therefore, you've got to be able to support that, and you've got to have commitment and conviction in the asset that you choose, and that it's going to do the job for you capital growth-wise. And even though Sydney market at the moment, as I mentioned, is a normal market, which is quite stable, we have had volatility in recent years. And so when it goes up, it really roars. And when it falls, it'd be pretty horrible too, right? On the other side of that. So I think if you look at the long-term trend, it's up, right? But you've got to choose individual asset. There's no point looking at the whole market as a whole, because I've known people have lost money in rising markets because they've chosen a poor asset. So it's very important, like in all, and that, I guess that risk applies in all three locations. The key drivers, very similar to in Melbourne, really. It really comes into, Sydney has a much more favourable climate than Melbourne. People want to come here for the beauty.
Oh, don't take me on climate, Veronica.
Yeah, I don't like humidity. But the point being that Sydney is a very desirable city for lots of reasons, for lifestyle reasons, and there's always going to be a desire for people who want to live here in good suburbs, in good locations around this city. So that's going to be a constant. That's not going to change. And equally, a lot of immigrants come here first. That's their first port of call. So in terms of the rental market in particular, that's quite a driver. So you've got sort of all of that going on. You've got, high income earners living here. You've got high income, high paying jobs. And the opportunity, I think, to be honest, I know it sounds a bit ridiculous, the opportunity is to buy an inner ring house, an A-grade house for less than $2 million. And because I reckon that little door's going to shut soon. and we'll be in the over $2 million for a house. And then you're really only going to be looking at apartments. So if that's your budget and you've been thinking around buying an investment property and you're wanting to get a house in Sydney, honestly, I think that is the door that's only ajar at this minute.
Interesting.
Very interesting, isn't it? And somewhat alarming when you think about it's $2 million for an entry-level inner-ring house.
Crazy.
In a capital city. This has been absolutely fascinating. I've learned a lot. I hope that those that have tuned in have learned a lot. Remember, we recorded this at the end of July 2024, so this is relevant in this period of time. It could have changed by next week, and I kid you not.
All right. So if you want to reach out to any of us, there's Cate
at catebakos.com.
Cate at catebakos.com.au. There's Megan.
Let's go with hello at propertypursuit.com.au. It's much easier than trying to spell my name.
Okay. vmorgan at gooddeeds.com.au. But look, we'll put the links below wherever. We don't even know where we're posting this yet, do we, ladies? But we'll put it somewhere.
Everywhere.
We'll make it really easy for you to contact us if you want to ask us any questions about buying investment or homes to live in our necks of the woods. Thanks for tuning in. If you stuck with us this long, then we really appreciate your eyeballs.
In this episode, we've only touched on a tiny part of the huge amount of things you need to know to become an educated first home buyer. There is so much more for you to do. You can learn all of the steps in the right order and avoid all of the mistakes that others have made in our 10-step online course for first home buyers.
If you'd like to learn more about the right process and avoid making rookie errors, become an educated home buyer. Head over to the website, check out your first home buyer guide, the course that we have created for you. And don't forget to subscribe to the podcast so you won't miss an episode. And if you've liked what you've heard today, please give us an iTunes review. It helps other people find us. And of course, I know it's a bit cringy, but we're going to ask for 5 stars. Thank you.
Thanks for joining us. We hope you found this really useful. And if you have, please share the love with others who you know are in the same boat. We'll be back next week with more priceless stuff.